Welcome, everybody. Thank you for joining us today. My name is Maggie Knowles with Disability Rights South Carolina, and I will be your host for our DRSC session today. Just a few notes. We are still waiting for our captioner to get here, but hopefully they will be here any moment and we will get them assigned. We do have an ASL interpreter pinned as well. Today will be a little bit different than our normal setup. So this session has been requested by multiple people for the past year or two. However, it is an area that Disability Rights South Carolina does not cover. So we have asked some friends to join us today, and we are very appreciative of them for giving us their time and taking over the session today. A few housekeeping things. The session is being recorded and will be put on YouTube afterwards, as always. Also, we're going to leave about 10 minutes for Q&A. You can put those in the chat box and send them to me, and I will read out the questions afterwards. And we will do that. We'll also ask at that time when you do questions that you don't put personal information into that question that would then get put on YouTube. So we'll try to keep that as generic as possible. If you are not able to use the chat, I prefer not to, you can raise your hand as well. Our next session and the last session for 2025 is going to be on September the 10th, and it will be on your rights and community access. So thank you very much, and I'm going to hand it over to our guest speakers to introduce themselves.
Good afternoon. My name is Sarah Garland St. Onge. I'm an attorney with Millender Elder Law and a supporter of the mission of Disability Rights South Carolina very strongly. I work particularly with clients who are having issues related to age or related to disability. That's what the focus of our firm is. And I'm here today with our associate.
My name is Morgan Compton Powell, and like she said, I'm an associate here at Millender Elder Law, and Sarah has been one of my primary mentors, and so I am also a very big supporter of this cause, and we're really excited to be here today to talk to you about what we specialize in.
Today, the focus is going to be on special needs trust, pooled fund trust, and ABLE accounts. And I have a couple of caveats. One is that this is not legal advice. This is general information. That's pretty obvious. Another thing that's pretty important for you guys to think about is that we're not talking about estate planning for people who may want to leave funds to somebody who's disabled. That's a different kind of trust. We usually call those trusts third-party trust or supplemental needs trust. But today we're going to focus on special needs trust or first-party trust. Sometimes they're referred to as D4A trust and similar tools that are out there to help you. Another caveat is we're talking about the law as it stands today. We're kind of in a time frame where the law seems to be changing very rapidly, and not always for the better, but that's just the way it is. So what we're talking about is how the law is today, but of course we can't guarantee you what it'll be like, next week. So anyway, I don't think this stuff's going to change, but I don't know for sure. Okay, so let's go on to the QR code for the PowerPoint. I think they're doing.
Okay.
Yeah. Okay. So if you scan that, my understanding is you can download a PDF of our PowerPoint. It's had several hands on it, so there's also a link that Maggie's putting up in the chat. So feel free to get that PowerPoint. I'll give you a few seconds to be able to do that, and then we'll kind of start with our program. Okay, so today's topic, so first of all, before we kind of start talking about these tools that we have to help people with disabilities, we kind of need to give you some context for that. I'm going to go over that, and then I'm going to talk about special needs trust. Morgan's going to cover pooled trust. She's kind of the expert on pooled trust in South Carolina. And then she's also going to cover ABLE accounts. ABLE accounts are a great tool that you can go access today because it's just so user-friendly. You don't have to have an attorney involved. It's great. And then we'll kind of guide you and give you some information so you can kind of know which tool is going to work for you. Next slide. So when we're talking about government benefits, this is the context. We got to give you some context for this. There are basically two types of government benefits. One is benefits you earn, so that when you work, you get taxed and you pay for Social Security in the future and you pay for Medicare in the future. And so when you become disabled, or you retire, you may be able to access those kinds of benefits based upon the fact that you paid into the system. They are earned benefits. Then, in addition to those kind of benefits, the government also provides what I describe as needs-based benefits. So, some examples of those kind of benefits would include Medicaid or supplemental security income. You may have heard that referred to as SSI. SNAP is another one. There's Section 8 benefits. There's some like veteran benefits. Some of them are earned because of your service, and then some of them are based upon needs if you're a veteran. So sometimes there's kind of a blending of these two different kinds of government benefits. But for purposes of today's discussion, we're going to be focused on those needs-based benefits. Next slide. Okay, so when you're talking about needs-based benefits, they're based upon need. So the government is going to look to see if you need help from the government. And so they're going to look at your resources sometimes, not all the time, but sometimes they're going to look at your resources, which means basically whatever you have carried over from month to month. So when you get money, you get your paycheck in and you put it in the bank. That's income the month that you receive it. But if you didn't spend all that money, let's say you have $200 left over, the $200 the next month is considered a resource. And so if you save $200 every month, it can build and add up. So that's the difference between income and resources. There is, if your income is too high or your resources are too high for whatever the relevant government program is, then you're not going to be able to qualify for the needs-based services. An example would be home community-based services through Medicaid. Our Medicaid agency has a Medicaid waiver called the IDRD waiver, which stands for Intellectual Disability Related Disability Waiver. Another waiver program that we have in South Carolina is called Community Choices Waiver. It used to be called Elderly, Blind, and Disabled Waiver. So that kind of tells you what who is on that waiver. And the income limit for those Medicaid waivers in South Carolina is $2,901 a month for 2025. That number goes up every year. The resource limit for a single person is $2,000. So that's not a lot of resources. So if you get 2901 a month and you're on that waiver, you're going to have to spend some of that money every month to make sure that you stay below your resources or do other kind of planning. Next slide. So there are some exceptions. Sometimes some certain kinds of income don't necessarily count. There are also more commonly exceptions for resources that don't count towards that $2,000 limit. So relevant to today's discussion, income placed into a valid special needs trust, the month is received, does not count as income for that month if the beneficiary is under age 65. So that's a lot of specific information, but basically what this means is that if you want to work and your income is going to be more than $2,901, we might create a special needs trust and it can shelter your income up until age 65, but you're probably going to retire at age 65 anyway. Another example would be resources placed into an ABLE account. These are accounts that are achieving a better life experience, I think is what ABLE stands for. It is, we have a link to a website on the PowerPoint that can tell you a lot more about this, and we'll get into a little more. But funds that you place in the ABLE account do not count as resources for purposes of SSI up to like 100,000. And they don't count, I think it's much higher than that. They don't count for resources for purposes of Medicaid. Okay. Am I missing anything?
Nope, that's right.
Okay. Next slide. So when are these tools used? If you, the tools being the special needs trust, the pooled trust, or the ABLE account. So if a person either wants to qualify for a needs-based benefit, or they're already on a needs-based benefit and they have are getting a windfall, let's say a rich uncle died or something like that, and they suddenly have some money coming to them, then these are the tools. Sometimes there are other tools as well, but these are tools that we use to help the individuals be able to continue to keep their benefits, because we can shelter the resources in certain circumstances into one of these three devices or tools. If the example when you might want to do it again is if you got a full-time job and you're on a Medicaid waiver. You had an inheritance, you got injured in a car crash, and you're getting a settlement from an attorney. We work with a lot of personal injury attorneys, and we help their clients figure out, if they're going to keep their needs-based benefits, if that makes sense, and if it makes sense to put it in a trust. It doesn't always make sense, and it's not always possible to do that, but that's kind of how we help them navigate that. And also, let's say you became injured and maybe you got a retirement account, or maybe you have a bank account and you are thinking about, let's say, going on the HASKey waiver, which is for head and spinal cord injuries. So you had a car crash and you have some money, that's some savings in the bank, and you want to qualify for the HASKey waiver. One of the things we can do is shelter your extra income by putting in the trust, or a pool trust, or an ABLE account. Next. So let's get into a little bit of the details. The devil's always in the details, right? So the next slide. So special needs trusts are authorized by federal law. Okay. Sometimes we call these trusts D4A trust. And if you look there at that site in our United States Code, it ends with D4A. So hence the name. Next. So basically, there are, I can't remember how many requirements we came up with, but this is the first three requirements for a valid special needs trust. Seven?
There's six.
Six requirements. So for a valid special needs trust, one of the first requirements is that it has to be a first party trust, which means it's for the money of the individual with disabilities. This goes back to what I said at the very beginning. This is not about planning. If you're a parent of a child with disabilities and you're thinking about putting money in a trust for your child for when you pass away, that's a different kind of planning. We also help people with that, but that's not what we're talking about here. This is a first party trust, not a third party trust. So it's talking about the money of the individual with the disability. For a special needs trust, the individual has to be under age 65. So they have to be under age 65 when they create the trust. Now, the trust doesn't go away when they turn 65. There's some penalties and some bad things that could happen with their Medicaid if they add assets to it after they turn 65. But essentially, they can still use a trust after age 65. So I think I created one for somebody at age 64. I'm working with somebody right now that age 63, but as long as you're younger than 65, you can put the money in the trust and then you can use it after you turn 65. That's fine. That doesn't cause a problem. Another requirement is the individual has to have a disability determination for the Social Security Administration. So that's pretty strict. You need to have been determined to be disabled. Next. So requirement number 4 is it has to be established for the benefit of such individual. Okay. The trust can only benefit the beneficiary who has a disability. It can't benefit other family members. And this becomes really tricky sometimes when maybe there's a settlement or inheritance for somebody who's married and has children. They have dependents. But if we put all the money into this kind of trust, a special needs trust, it can't be used to help the dependents. Sometimes it's okay if there's like a collateral benefit. I know one individual, their trustee pays for cable for the person with a disability, or maybe Netflix or something like that, and the whole family can watch Netflix. So there may be some collateral benefit that's allowed, but they couldn't, for example, buy a car for the 16-year-old child of the person with the special needs trust, or pay for them to go to college or anything like that. So that could sometimes make the planning tricky when an individual has a family that they also need to worry about and be taken care of. Next. Number 5, the quote over there on the left, well, it's on my left side, the left side of the screen. These quotes are from the actual statute that I cited to, that D4A. So just in case you're curious about that. But only certain people can create this trust. Morgan and I are not related. I cannot create a trust for her. I cannot be the settler of a special needs trust for her if she needed a special needs trust. And she could not do one for me, although I'm not that much under 65. Anyway, it has to be created only by a parent, a grandparent, a legal guardian of the individual. I should say that first: the individual, a parent, grandparent, legal guardian of the individual, or a court. The adding of the individual was actually fairly recent. We had a really weird situation where you could have a disability and be completely competent, but the law didn't allow you to create a trust for yourself, which was ridiculous, but it did get changed. It's been probably couple decades since that got changed, maybe 15 years. A trust that's created by Uncle Joe will not work, and the assets in it will count for purposes of the benefits of the disabled individual. An individual does not have to be able to read or see or hear to establish a special needs trust. They do need to be able to understand what they are signing, or having someone sign for them if they're unable to sign themselves. They don't need to understand every word. So if you can understand the basics of what is in the document, even if it has to be read to you, then you can create your own trust. Unless you've been determined to be incapacitated by court or something like that. But lots of times the individuals themselves are able to be the creator of the trust, or we use this weird term called settler, the creator or the settler. Or go ahead.
Another way this trust could be created is if the disabled individual has a valid power of attorney. A power of attorney is a document by which an individual kind of shares rights to manage finances with another trusted person who we call an agent. And if that power of attorney has the appropriate powers within it, then sometimes an agent can create the trust on behalf of the disabled individual.
And they would treat the individual as being the creator of that trust, even though it was done by the agent. So, and I confirmed that with the lawyer at DHHS one day. Okay, next slide. So last but not least, you may have been thinking, this sounds too good to be true. You get to keep your needs-based benefits, but have a whole lot of cash socked away in a trust for your benefit. Well, there's a catch. And requirement 6 is the catch. So if the state, it's only valid if the state will receive all amounts remaining in the trust upon the death of such individual up to an amount equal to the total medical assistance paid on behalf of the individual under a state plan under the subchapter. So that means Medicaid. So essentially, the money in that trust when the beneficiary dies and the beneficiary is the person who benefits from the trust. The person, maybe they created the trust, but the person with the disability who the trust is all about, that beneficiary, when they die, the funds in the trust, and it could be all of the funds of the trust or a small portion of the funds of the trust. It just depends upon how much Medicaid paid out during the individual's lifetime. But then it has to be paid back to the Medicaid agency. Sometimes it could be that it doesn't mean that just because the Medicaid agency sends a bill that everything's correct. You can question what they send. We just got a recent case law on that. It can be questioned what the Medicaid agency says the bill is. Also, if there are multiple states that an individual lived in, the trustee may have to pay back more than one state. So if you live in South Carolina now, but you're in North Carolina for 10 years or something like that and on Medicaid, you would have to pay South Carolina and North Carolina back. So next slide. So a few other considerations to think about is a special needs trust doesn't always work. Obviously, if you're over 65, it's not going to work. We're going to have to come up with some other ideas. You should have an attorney draft this trust, somebody who is experienced in drafting these kinds of trust, because it's going to have to be reviewed by the Medicaid agency and by Social Security. And if it's not up to snuff, you could be in a whole lot of pain and have to go to court and have a big mess on your hands. Another thing to keep in mind is because you need an attorney involved in this, this is probably the most expensive of these three tools. So lots of times when there's not a lot of money involved, we don't recommend this trust because it just doesn't make any sense. Like if you're only getting $5,000, why would you spend thousands of dollars trying to create this kind of trust, you know? So we look at other tools for that reason. It's very important that you choose a trustee well. I tell people, one, it needs to be the kind of person that if they accidentally got too much change, they would take it back to the restaurant. That's the kind of trustworthiness that you need for the person who's going to manage the money. If you're going to use an individual and not have a professional trustee, it needs to be somebody very trustworthy. Also, the other thing that's important about who you pick as a trustee is that the individual needs to have a lot of common sense. Like they need to be kind of a rule follower, if that makes any sense, because there's particular rules that they're going to have to follow about spending the money from the trust. And if they don't keep an accounting and they don't keep up with it, or they spend the money on the wrong thing, it could impact the benefits of the person with disability that the trust is supposed to benefit. There are reporting requirements with both Social Security, probably all the needs-based benefits, Social Security and Medicaid. The Medicaid agency, the Department of Health and Human Services, DHHS, they don't carefully track the funds of these trusts. They do track the funds, but they're not currently being really strict on that. But what we tell everybody is you need to pretend that it's strict because they could change that at any moment. And they may look back as much as 5 years and say, oh, you weren't doing this right. And it could cause problems. So, even if all they want is a statement once a year, the trustee is really going to need to keep careful books and careful accounting of the funds that are in that trust. The Medicaid agency will definitely look towards that payback. So, next slide.
Okay, so now we're going to go into our second tool, which is a pooled fund trust. I'll probably just call it a pooled trust because that's a mouthful. But it's very similar to the first party special needs trust that Sarah just explained to us. It is authorized by and must comply with the same federal statute, but just a different subsection of it. So first party trusts are D4A and pooled trusts are D4C. So we're in the same world and you're going to see a lot of similarities. And so what I'm going to do is point out some of the key differences that I want you guys to be aware of. Okay, next slide.
Somebody's going to ask what B is, and we're not don't know that I can tell it off the top of
I
my
don't
head.
remember. So
Don't ask that.
the same way we did with the first party trust, I think the easiest way to think about these is to break down the statute into its many requirements. So again, it's another first party trust, meaning the assets have to be belong to that individual who is disabled, and that individual must have a disability determination from Social Security. So again, same starting requirement as the other. You'll notice it's missing that age requirement though. And something special about South Carolina is we still get penalized if we put anything into it after age 65. So generally, we still don't recommend this trust for people under age 65, but if or over age 65, yes. But if you move to another state, then this may be a different option. We don't know. We only do South Carolina law. So I wanted to point that out. Okay, next slide. So this trust is unique because it must be established and managed by a nonprofit association. So the settlor, the person who creates this trust, has to be a nonprofit who is established and certified under our state nonprofit statute. So the easiest way to know if a nonprofit is allowed to have this kind of trust is that they have that tax exempt status under the Internal Revenue Code or the IRS. Okay, next slide. A big part of these trusts is the management. So it's easily satisfied if that nonprofit is the creator of the trust and they're also the trustee. So when we're talking about a trustee, we're talking about a person who has the decision-making authority over the money in the trust. So if the nonprofit has maybe a board of trustees where they have a system by which they decide how the money in the pooled trust is spent, then they are also the trustee, and this requirement is very easily satisfied. However, many nonprofits, they're not banks. They may want to hire a for-profit entity like a bank to do some of these financial activities. So one thing that we focus on, we kind of work on both sides of this trust. And so sometimes we help nonprofits make it very clear that they're the ultimate manager of the pooled trust, because if not, then this is no longer a valid pooled trust, and then any participants, could be in a world of hurt. So we do look at it from both angles and try to ensure that if anybody is joining a pooled trust, that it's also being properly managed so that your money is protected as well. Next slide. So this pooled trust gets its name because each beneficiary who is participating has a separate account, often called a sub-account. So the larger trust that the nonprofit controls can be divided into many little sub-accounts that have varying amounts of money in them for each individual person. So that sub-account just includes the property contributed for that one specific beneficiary, and it's invested and managed appropriately, but they're all pooled together for purposes of investing and for easier management for the pooled trust. So it requires a lot of accounting work on the trustee side, which as a participant, you would not have to worry about. But as an attorney, we do worry about making sure our nonprofit are accurately accounting for each individual, because if you have 150 participants, that's 150 sub-accounts. So if you ever participate in a trust like this, you should be receiving an individual accounting for your sub-account that shows any increases or expenditures that may have been made. Next slide. And I kind of jumped ahead, I already said this, but for the purposes of investment and management, the trust funds are pooled. So again, they're all combined together, invested and managed together. Any investment gains or losses are distributed pro rata amongst all of the sub-accounts. So it's proportional to how much money is in that particular sub-account is the loss or gain based on investment. All right, next slide. So sub-accounts in the pooled trust have to, again, be established solely for the benefit of the disabled individual. These sub-accounts cannot provide a benefit to any other person during the beneficiary's lifetime, which again can cause us some discussion when a beneficiary is married or has dependent children or things like that. The trust can only make payments to the beneficiary on behalf of the beneficiary or for the benefit of the beneficiary, meaning that a lot of times beneficiaries or their families will ask the nonprofit trustee if they will pay an entity on their behalf to purchase a particular good. For example, the internet payment Sarah was talking about, instead of paying the money to the disabled individual or their family, then the trust would probably just pay the money directly to Spectrum or AT&T or whoever is providing that service. Okay, next slide. So for creating these sub-accounts, again, it's a parent, a grandparent, a legal guardian, or the individual themselves, or by a court. And again, a power of attorney with appropriate authority for the disabled person, or even for that parent or grandparent is valid. So if you guys are ever doing your own estate planning, this is something to keep in mind, that maybe we want to include this power if you have any disabled family members. Next slide. Okay, so a quick reminder. Sub-accounts have to contain the assets of the disabled person. So there are really two issues when we're talking about pooled trusts and special needs trusts, is who can establish that sub-account, like we just said, parent, grandparent, guardian, etc., but also who can fund the account. Guardians don't always have access or authority over an individual's money. So we kind of have to think of it in with the two separate issues. So a third party that's establishing the account still needs authority to actually move the person's money into the account if that disabled person can't do it on their own. So sometimes an attorney may need to be more heavily involved in this kind of thing as well. Next slide. So the fifth requirement is also, again, that catch, because again, it sounds a little too good to be true, but upon the death of the disabled individual, the funds should have a payback provision. But there's a bit of a caveat for pooled trusts. So the nonprofit association is allowed to retain amounts upon the person's death. So instead of it all going back to pay back the state, typically these nonprofit associations take advantage of this and allow the funds to be retained for their nonprofit. And a lot of times it's distributed to the other participants in the pooled trust. So if someone passes away, then their fellow participants may get a bit of a windfall in their own sub-account. So some people feel that this is like a good way to benefit a nonprofit, benefit their fellow participants, and, you know, some people like the idea of it not all immediately going back to the state, and I can't blame you if you feel that way. I don't know, I just want to make sure I'm not missing anything. Okay, next slide. But to the extent that the nonprofit doesn't keep it, it is paid back to the estate for the Medicaid benefits during the person's life. So like Sarah was saying, there's basically a tab that's ran up if a person is on Medicaid during their lifetime, and that Medicaid doesn't expect to get paid back from until that person's death. And so there is that payback provision that's normally circumvented, but not always. Next slide. So some more considerations about pooled trust. I mentioned this at the beginning, but in South Carolina, if the beneficiary is under age 65, then any additions to a sub-account are exempt from a transfer penalty. But if they're over age 65, then we might have some penalties that would be incurred, and it's something we want to keep in mind and maybe would prevent us from recommending this tool.
And let me jump in
go
here
ahead.
just for a second. So not all Medicaid in South Carolina has penalties. Like I like to say, Medicaid is a whole bunch of different programs, and they all have different rules. So when we're talking about penalties, that's primarily nursing home Medicaid and home and community-based waiver Medicaid, where a Medicaid, if you give assets away or you hide them in a trust like this, it's irrevocable, or even a pool trust, so that you can continue to qualify, then they will impose a penalty. And it's like for every $9,500 that you either give away or you transfer to an irrevocable trust, after age 65, you'll have 1 month where Medicaid will not pay for the nursing home or won't pay for the home and community-based services. So just to kind of explain that term.
What about SSI?
SSI also will be reduced if you're on SSI, and you may lose other benefits too. I'm currently doing research on it, how it impacts housing, and it's really complicated.
So the key to know is if you're over age 65, it might create more problems than it would potentially solve. It's also a really great tool when there's a need for a professional trustee, but the amount of money may not justify creating a standalone first-party special needs trust or paying a corporate fiduciary like a big bank, think Bank of America, Wells Fargo, paying them fees. Most banks like that have trustee fees that are taken out of the trust account. And so when someone maybe isn't getting as large of a sum of money to justify those kind of fees, it's not desirable, then a pooled trust can be a really wonderful option.
And that's only if the bank is serving as trustee.
Yes.
Not just a regular account.
Yes, just a trustee account. Another thing to keep in mind is not all nonprofit associations operate these pooled trusts. As you can probably tell, they can be a little complicated to operate, and not everybody wants to dip their toe into that. So options can be limited. And then again, not all pooled trusts are open for anyone to participate in. Most have created additional requirements that to participate, the individual must be receiving services from the nonprofit already or be a resident in any kind of residential program they run. The legal requirements to be a participant are just that the disability and that the assets are your assets, but the nonprofit can create additional requirements. So something to keep in mind. Okay, yes, next slide. All right, now moving on to our final tool of an ABLE account. So ABLE stands for Achieving a Better Life Experience Act of 2014, and it was passed to provide a way for people with disabilities to save for disability-related expenses. So you may have heard of a 529 account. This was created under the same kind of statute. It's a 529A account. Next slide. The only requirement for an ABLE account to participate in an ABLE account is that you have to have a qualified disability before age 26. So it doesn't matter how old you are when you create it, but you have to have been disabled before you were age 26. However, in 2026, so just next year, that age will go up to 46, which we are very excited about because that'll make this tool accessible for more people. But that's the only requirement, is that you don't necessarily have to give them documentation of that disability, but if the IRS comes asking, you need to be able to assert to the IRS that yes, you were disabled before you were age 26. Next slide. Next slide. Okay. So the key features of ABLE accounts is that the deposits are limited on an annual basis. You can only put in up to the gift tax exclusion limit, which is a number set by the IRS every year. And for this year, it's $19,000. You may be able to put more money in per year, though, if you are working and you're putting in some of your salary and your earnings from working. This account can pay for qualified expenses, which can include rent and food. Again, you have to have that qualified disability before age 26. But a big pro of an ABLE account is that there are very minimal fees to these accounts. They're online, very accessible to create, and it's essentially a debit card that you can use at your convenience. It's very minimal fees and very accessible. One big thing is that it cannot shelter income the way that the special needs trust can. So your income is still countable for purposes of those needs-based benefits. You can put your income in there, like we already talked about, if you want to save money more than that $2,000 resource limit, but any income you earn still would count even if it's put into an ABLE account. Another big thing is that SSI is not impacted up to $100,000 that is put into the ABLE account. So if you put more than $100,000 in your ABLE account, then SSI may be impacted. However, Medicaid is not impacted regardless of how much money is in the ABLE account. So it's a really great tool for especially people who want to have more savings, or if they're getting money that's less than $19,000 per year. This is a wonderful tool, again, with very minimal fees. It's probably the least expensive of all the options if you qualify for it. And it's a tool we love to utilize.
It doesn't, and you don't need an attorney to do it. You just
That's
go to the
true.
website and set it up and,
Mhm.
you know.
Yes, we normally point people to it, and that's about as involved as we get. It's really wonderful. It's, again, so accessible. All right, next slide. Okay, so now we're going to start talking about which tool is the right tool for you. And so depends on the scenario, again, how much money, but these are just some of the considerations and factors that we take into account. So one of the biggest things is the age of the beneficiary. When the beneficiary became disabled, again, before 26, who can serve as trustee? So are there trusted individuals who are money minded and responsible, and as Sarah said, would run back in the restaurant if they got too much change, who are trustworthy individuals in the beneficiary's life who could be involved and take on this job, because being a trustee is a job. There are a lot of rules to follow and a lot of responsibility ensuring that the money in the trust is used appropriately. So we need to make sure that the person has people in their life that would be willing and able to do this. And if not, maybe contacting a nonprofit who could. Again, how much money is involved? As you see, the ABLE account has a low money limit for each yearly contribution. So that kind of may knock that tool off if it's a large sum of money. And again, balancing the money that's due to the beneficiary with the expected costs of creating and using one of these tools. Also, is there a need to shelter income or resources, or both? But, does the individual have just too much income because they're working now, but resources wise, they're fine. They would just like to save. Or is it the other way around? Is there that rich uncle who unexpectedly left an inheritance, and, we want those resources saved to benefit the individual? And then if there's a spouse and children in the home, how will they be supported if we take this money and put it into a trust that is not allowed to benefit spouse and children? That's something that we need to consider. So maybe we take only some of the money for the trust, or we might have to get creative and come up with some other ideas. And then also, just what benefits are we trying to save? Sarah kind of mentioned earlier that Medicaid is a whole lot of different programs, and some of these programs have different requirements and different factors that we need to think about when planning. We've talked about the most common requirements of Medicaid and SSI, but there are other benefits out there that may change some of these numbers that we talk about. And Sarah put in a very helpful hint that sometimes the answer is just none of the above.
None of the tools are right. Like I had one young person who was getting like a $2 million settlement, and we discussed the options, and he was just like, no, I have enough money. I can pay for my own care. I can pay for everything I need. I don't know that he made wise choices after that, but that's not my problem. And but that's it was really I thought that was a completely rational decision, that he decided, no, my benefits, I'm not getting enough benefits. I'd rather have flexibility, because once the money is put in these trusts, there's no flexibility. You can't support, he was a young person who hoped to get married and have kids someday, those kinds of dreams. If all your money is in a trust like this, yeah, it can take care of you, but it can't take care of anybody else. So, I think a lot of people get kind of blindsided and they don't think big picture. And sometimes, your benefits, you may be on Medicare and Medicaid, and Medicaid's not even paying very much. And you may say, well, I'll just go off of Medicaid to keep the flexibility. So, Lots of times we do want to use these tools, but not every time. Yeah, I think we're at our 10-minute time work down.
Yeah.
Mary or Maggie? Macy or Maggie?
Questions yet, but if you do have a question, you can go ahead and put it in the chat, and we will get to that.
It was just so clear.
Yeah.
Do you want to go back to one of the scenarios since there's no questions yet?
I do just a comment that there is the working disabled Medicaid category.
Yes, that's the
it.
category. That's right. Good job. Thank you. Scenario number 2, single mom. Samantha is a single mother, age 25. She's received a $100,000 settlement from her car accident. She is on Medicaid. She is not on disability. Her child is also on Medicaid. So one of the important things in this scenario to note that tells me a lot is that this individual is not disabled, but they're on Medicaid. Like I said a while back, 45 minutes ago, is Medicaid is a whole bunch of different kinds of programs. It's not just one thing. So there's a good chance that Samantha is actually on caretaker Medicaid because she's caring for a child that it qualifies for Medicaid. Most likely this is due to low income. We sometimes call those the MAGI programs, MAGI. Don't modified adjusted gross income. Yes. Good, thanks. And so for those MAGI programs, there's no resource limit. So Samantha could continue to qualify for Medicaid by putting this money in a bank account. Now, if the money generated enough income, like if there was enough interest off of that bank account, or it was more like $300,000 instead of 100, the income may impact Samantha's Medicaid, but most likely this is not going to impact her. Now, it would be different if she was disabled in an accident and is on a Medicaid waiver at this point. If she's on a Medicaid waiver, then her resources have to be below $2,000. And so in that scenario, we would have to think about either a special needs trust or the pooled trust, or depending upon, she was disabled before age 25, so we could also do an ABLE account or some combination. Next scenario. You want to take this one? Read it?
Okay. So Max received a spinal cord injury in a car accident, and he's about to receive a settlement of $130,000. He's 35 years old, and he has disability payments from Social Security, and he's also on a Medicaid waiver program that provides a caregiver to assist him in his home. So one thing about this is if he's got a caregiver in his home, when we think home and community-based services.
Probably.
So, and he does have a disability, so we probably would be recommending this first party special needs trust in this scenario. With that sum of money, he could likely do a pooled trust as well, 130,000. But if we add another zero to the settlement, so a $1.3 million settlement, then definitely a first party special needs trust. Probably
or no trust.
Yeah, or no trust. That's
Or
true
no
too.
trust.
He may decide that the flexibility and paying a caregiver privately is fine. With that amount of money, you could probably justify a corporate trustee and some
Definitely.
Yeah.
Usually for like professional trustees and such like that, you have to have pretty significant resources to get, like for a small bank, they might do it if there's 200 or 300,000 ish there. For larger banks, they're going to want over $1 million probably before they'll agree to be the trustee of a trust. And so, a lot of people don't have anybody in their life that can manage money and do what's necessary. So we're frequently recommending some kind of corporate fiduciary. We try to deal with people who are in South Carolina. We usually deal with smaller banks who are insured. I had one client who had funds in a company that was kind of more fly by night that was in Florida, and they actually, whoever was the executor of that company stole money. So, we've had some of that fraud and things like that going on in South Carolina too. So just because it's a corporate fiduciary does not mean that you're off the hook for doing your due diligence to make sure that they are valid, that they have all their licensing requirements met, that they have insurance, all those kinds of things, so that if a trustee does decide to take off with your money, that you can get that back. Another thing that I don't think we've covered is that each one of these tools have investment options. With the pooled trust, you don't have any, it is invested prudently, probably pretty conservatively, but it is invested. So it should, in good years anyway, it should increase in value, the amount that you put in there. It's not like just putting it in a bank account where it's stagnant. And so it is invested. With the ABLE account, you kind of have choices about how aggressively you want to invest that money, but you don't have unlimited options, at least the last time I looked at it. But you can say, well, I want to invest this aggressively. So, like in our scenario where the young lady wanted to buy a house, but she wasn't going to be ready to buy that house for a while, she, would probably want to be pretty aggressive with her savings. And with the special needs trust, the fiduciary has to be prudent. Whoever the trustee is, they have to be prudent. The trustee is what we call a fiduciary, meaning that they're responsible for somebody else's money, basically. And the trustee has to be prudent in their investments, but they should invest the money. Again, it kind of depends upon how much there is. We usually, if it's an individual trustee, we usually recommend that they find a good financial advisor or somebody to advise them on what an appropriate investment strategy is. Obviously, if they're going to need some of the money coming up, then they'll want to do that. I don't think any questions, Maggie?
We're actually getting ready to close up. It's almost 1 o'clock. If Macy, if you could put their contact slide up just for a second, so that we can end with that. And we appreciate it very much for both of you guys joining us today. And if you guys have any other following questions, you can get in contact with them. And that will be everything for today. So thank you very much, everyone.
Thank you, guys.
Thank you, guys. We enjoyed it. Bye.